It's 8:30 a.m. Eastern. Good morning. My name's Adam Rosen. Very happy for you to join us. It's 8:30 a.m. Eastern. Welcome to FX Street. Very happy you could join us. Personal income numbers are being released as we speak right now. Please let me know, by the way, if the sound is not strong enough. I think it should be. Personal income up 0.1% in June. The consensus up 0.1%. So that's unchanged. Personal spending down 0.2%. That was consensus was unchanged. So that's a little bit worse than expected. Core price index up 0.1% on the month, 1.3% on the year. 0.2% loss on the PCE price index on the month, 2.6% on the year. May personal income revised up 0.2% from 0.3%. So it looks like it's a little bit worse than expected. We're going to take a look actually at the calendar to compare this to what our consensus was. Let's see. Okay, so this is the FX3 calendar. Okay, so we have personal income up 0.1%, less than expected. The personal expenditures month over month, we had a drop. We were expecting a gain of 0.2%. Core personal consumption expenditures up 0.1 versus the consensus of 0.2. So everything looks like it's a little bit less than expected right now, and that's not good. That's especially following yesterday's ISM numbers, which were certainly not good at all in the U.S. and certainly helped stock markets lower. Earlier today, by the way, we had the Reserve Bank of Australia. They left interest rates unchanged at 4.75%. According to Bloomberg.com, they said, the Reserve Bank of Australia said, while its board's considering boosting borrowing costs, it was prudent to hold off because of a clouded global economic outlook. Governor Glenn Stevens held the overnight cash rate at 4.75. He says the board remains concerned about the medium-term outlook for inflation. He cited acute sense of uncertainty in financial markets as a key factor for inaction. Kind of interesting, because last week, the Reserve Bank of New Zealand met. And we're going to get to the topic of the day because that's something that's pretty timely as well. But last week, the Reserve Bank of New Zealand met. They left the rates unchanged at 2.5%. Now, if we go back into not ancient history, just recent history, we know the Reserve Bank of New Zealand cut rates from 3 to 2.5% in March following the earthquake in New Zealand, right around the same time as the earthquake and tsunami in Japan. Governor Alan Bullard from New Zealand, from the Reserve Bank of New Zealand, called it his insurance plan. Basically, let's cut interest rates now, preemptively, back in March, in order to stimulate the economy and help it through what was the deadliest earthquake, the worst earthquake in like 80 years. Well, last week they left rates unchanged, still at 2.5%, but the Reserve Bank of New Zealand pretty much left the door open to raise rates maybe as soon as next meeting, September. The one caveat that they left is they said pending the global condition, the debt crisis in Greece, and even more, what's happening right now, more relevant what's happening right now in the U.S. with the debt ceiling crisis. Will the U.S. be able to raise their debt ceiling? And even if they do raise the debt ceiling, will S&P still downgrade the credit rating? Either one could have certainly a very negative effect to the market. I mention it because it's interesting because Australia the Reserve Bank of Australia did the same thing. Aussie and Kiwi, if you've noticed over the past couple of days, has not really sold off the way the euro has, the way the pound has. When you look at the euro yen versus the Kiwi yen, let's actually look at those charts. They're two different markets. Typically, when you have a big, very directional move in the market, like we've seen over the past couple of days or so, usually everything kind of moves together. Usually you'll see euro yen, pound yen, Kiwi yen, CAD yen, Aussie yen, etc. Everything kind of goes together. That has not been the case. Oops, here's the charts. That has not been the case as of late, I should say. The euro-yen has been absolutely clobbered. We can draw downtrending resistance and hopefully this sort of parallel fashion support. Now that's nice. Okay, so we're at 109 on the euro-yen, and we were just at like 113. That's 400 pips in the past couple weeks or so. Compare and contrast that to the Kiwi yen, which yesterday hit a new, I don't know if it's an all-time high, but a very, very significant high, 68.87 were yesterday's highs. It's not all-time high, but it is highs going back to April of this year. So the question is, why is the euro-yen down 400 pips in the past 2 weeks? Why is the euro-yen down 400 pips while the Kiwi yen is not? The fact of the matter is the Aussie and the Kiwi have not participated as much in a sell-off as the euro has and the pound has for very good reason. Not that there's anything wrong with the euro or the pound, but more so that the Aussie and Kiwi are quite resilient. The central banks, Australia last week, New Zealand New Zealand last week, Australia earlier today, they basically said, look, things look good. Inflation is continuing to increase, to persist. We want to raise rates, but we're a little uncertain with the global situation that's going on. So the Aussie and the Kiwi currencies are very interesting proxies. If you think things are going to get better, if you think that this whole debt contagion crisis will pass, look for the Aussie and the Kiwi to the upside, because there's no other fundamental reason why these currencies should go down. Quite the contrary. Both central banks have talked about rising inflation and the need to raise interest rates. Interesting stuff. Okay, topic of the day, by the way, I want to get to the topic of the day also, but it's very important. Later on today, the Senate will vote. Congressional leaders, this is from Bloomberg, congressional leaders voice confidence that Senate will vote today to ratify the U.S. debt limit compromise that will avert defaults, even as it defers decisions on nation's finances to a bipartisan panel. Okay, I'm not going to read the whole thing. The House voted, House Representatives voted 269 to 151 yesterday to approve the measure, and it raised the national debt ceiling enough to fund the government until 2013. Interesting, 2013 to after elections. And threatens automatic spending cuts to enforce a goal of cutting $2.4 trillion in the next decade. Okay, the details we can, look at another time. What's interesting is the market's take on the fact that will S&P consider this a short-term or long-term solution? Does Standard & Poor's rating agency consider this the U.S. kicking the can down the road, meaning we're going to raise the debt ceiling now, but we are not really fixing any big fundamental problems? If that's the case, then we have a greater chance of Standard & Poor's or another ratings agency downgrading U.S. credit rating, and that could be devastating for the bond market. On the other hand, and also the stock market, of course, on the other hand, if this is perceived as a long-term solution, then maybe we've seen the worst. In terms of really quickly the bond market, and I would urge everyone, if you don't already, if you trade foreign exchange, watch the bond market. This is a snapshot, and I'll give everyone the link, from Bloomberg.com, of the U.S. 10-year government bond. I like to watch the 10-year government bonds because they all the different countries have 10-year bonds, so they're very easy to compare against each other. This chart is the yields of the 10-year bonds. Now, the yield of the bonds, which is currently a little bit under 3%, it's actually 2.69, moves in the same direction as the stocks and the same direction, generally speaking, as a currency. When times are good, stock markets go up. The bond market has to offer higher yields. The yields go up. Remember, the yield and the price has an opposite correlation. When the yield goes up, the prices go down. Because if the bond market has to pay a higher yield, it means each bond's worth a little bit less because they have to pay a higher yield. Anyway, it doesn't matter. The important thing is that the yield moves in the same direction as the stocks market, and the yield moves in the same direction as the currency, generally speaking. Lately, I'm sure you've noticed the dollar has been pummeled to the downside. The yield on the 10-year bond has also been pummeled to the downside. The bond market so far, and I find this very, very interesting, does not believe that the credit rating in the U.S. will be downgraded. Because if it did, we would see yields going up and very, very fast. when you have the chance, take a look at a multi-year chart of the 10-year bond market in Greece. A couple of years ago, you could have bought 10-year bonds, 10-year government bonds in Greece and received a 5% coup, 5% yield. The yields in Greece are upwards of 14% right now. When the risk of default increases, the yield goes up. More risk, more return. Well, so far the bond market's telling us, number one, we don't think that the credit rating of the U.S. is going to be downgraded, because otherwise we would hold higher yields, we'd offer higher yields. But more importantly, the yield's actually going down, because yields, remember, they go in the same direction as stocks. Stock market was down yesterday, the yields are down yesterday. Take a look at today. We closed yesterday, the 10-year bond, we closed at 270 something. We're at 269 now. We're down almost 2%, 5 basis points. We're close to 274, I think, yesterday. 5 basis points is 0.05%. And it's important because this tells us that, first of all, stocks are probably going to open up lower. And number two, the dollar is probably going to also continue down. Really, really interesting stuff. Let's get to the topic of the day. There's so much going on. It's hard to ignore all that other stuff. Okay, so we take a look, and we'll go back to the FX Street calendar for a second. Now, when I tell you that the summer trading months of August tend to be slow months, you're probably not going to believe me, judging from yesterday's trading action and most likely today's trading action. It's very, very typical. You can almost narrow it down to the first week in August. The first week in August basically represents the last week of the big July earnings season. You see, we have corporate earnings 4 times a year: January, April, July, and October. That's when the corporations report their quarterly earnings, and that's when stocks move, based on, the disappointment or surprises to the upside. Either way you cut it, stocks move during July. August tends to be very, very quiet. If you take a look at the economic calendar, and you're able to, on FX Street's calendar, isolate only the really, really big numbers. Let me isolate the big numbers. Click over here, Advanced, move this little indicator bar all the way over to the right. And you take a look at the big economic numbers this week. Well, we had earlier today Reserve Bank of Australia. Tomorrow we have retail sales in the Eurozone. Thursday, we have Bank of England, European Central Bank meetings. Friday, Bank of Japan, U.S. unemployment numbers. We have Canadian unemployment numbers. That's Friday. August 9th, Federal Reserve interest rate decision. Now this is the rest of the month of August. I looked for the entire month of August. The rest of the month of August, after next week's Fed meeting, what do we have? Eurozone GDP, UK GDP, US GDP, and Canadian GDP. We have 4 gross domestic product numbers for the rest of the entire month. Congress is going to be on vacation. Not really any kind of economic data. No other central banks are reporting. No corporate earnings. In other words, no reason for the stock market to move. No reason for the foreign exchange market to move. These 3 weeks, the last 2 or 3 weeks in August, represent some of the quietest times of the year, alongside with probably the last couple of weeks in December, right around the holiday season. But even those weeks tend to be volatile. So the question is, how do we trade those last 2 weeks? And I'll tell you from a personal note, and I've spoken about this before, I'm sure, and I'll repeat it again, because I think it's such an important lesson. For me, such a painful lesson. If you talk to any old stock day traders, they'll tell you, and you ask them what was the best month of the year, they would tell you July. You ask them when did you make the most money, they would say July. If you ask them when did you make the only money, they would probably tell you July. July tends to be the best month of the year for stock traders, for whatever reason. Maybe it's sandwiched in between June and August, which are rather quiet months. Maybe because October tends to have a little bit more of a negative sentiment. Who knows? But July tends to be one of the most active times of the year. Fantastic time for trading, for day trading. I'm sure you can tell from yesterday's movement. August tends to be one of the most difficult times of the year, and the most difficult part for me for day trading, in a previous life when I used to day trade stocks, is that making that transition from July to August. Because in July, you take a look at, we compare it to the foreign exchange market, you take a look at the Euro Swissy or the dollar Swissy. Let's take a look at the dollar Swissy. This thing has been active. This thing has been fast. This thing has been moving. Dollar Swissy. Here's a 1-hour chart. If we had, looked to sell short, obviously we're going to sell short the dollar Swissy. The trend is your friend. And in all these trend lines, but you just look for a retracement. You say, okay, the dollar Swissy went down. I'm going to wait for a rally to sell short. It sells off. Wait for a rally to sell short. It sells off. Wait for a rally. It sells off. I mean, we're walking down a flight of stairs on the dollar Swissy. Here's a 4-hour chart. Basically, every time there's some sort of move, we're rewarded for trading in the right direction. The market tells us, hey, we're doing the right thing. The dollar Swissy is going down. I want to sell short. When the market rallies. Almost every time the market rallies, we can sell short. And we can see by this trend line, it holds, let me get rid of these other ones, but it holds pretty closely to our downtrending resistance. I mean, there's not a lot of mystery as far as which way this market's going to go and, most probably where there's another good spot to sell shorts. Question is, wasn't this July complicated and tricky? Every July is complicated and tricky. Every single day was complicated and tricky. I would say, yeah. I mean, in particular, I would say this past July has certainly been eventful. We've had a lot of cross currents. I mean, just think of all the issues we've talked about over the past couple of weeks. 2 weeks ago, if you asked me, I'd say, well, the big issue was Greece, Ireland, possible downgrades, further downgrades. A week ago, we said, well, what's going to happen with this debt ceiling crisis in the U.S.? Now that if the Senate, everybody anticipates the Senate will vote to pass this compromise, the same as the House did last night, the next issue is, okay, well, does this mean that S&P Standard & Poor's will still downgrade our debt? There are a lot of cross currents, and that's on top of corporate earnings. But yeah, but point being is that it was complicated. I think it was action-packed this July. That's for sure. It was an action-packed movie. But there was movement. And that's what we as traders need. August, imagine a period of time. I know it's difficult. That despite all the news, and the news will not disappear. I promise you, there will still be big pieces of news in August. It's just the market is not going to respond to them. It's not because the market doesn't care. It's because the volume will dry up. See, the volume is the fuel that moves the market. Here's the Dow Jones Industrial Average chart. And we're going to throw in an indicator, a very common indicator called the Bollinger Band. The center line is a 20 simple moving average, and the two other lines are that same moving average extended 2 standard deviations above and below. Now, make special note of the width of the Bollinger Bands from low to high. When the Bollinger Bands are far apart, it means the market's very volatile. When the Bollinger Bands are close together, it means the market's kind of quiet. Take a look at the Bollinger Bands now. The lower band currently rests basically where we are now, near the 12,000 level. The upper band, 12,800. We have an 800-point spread in between the lower band and the upper band. Compare and contrast that to not too long ago, July 24th, before everything really started to heat up. We had lower band 12,375, the upper band 12,759, 3 to 7, that's 4, less than 300 points. Less than 3 to 400 points on the Dow. We went from a spread of 3 to 400 to now 1,200, or I should say 800. Look, even before that, going back to June, which is known to be kind of a quiet month, 11,008 was a low band, high band 12,002, 400 spread. We went from a spread of 400 points on the lower band to the upper band to a spread of 11,700 to the upper band, 12,800, 1,100. We went from 400 to 1,100 point spread in a very, very short amount of time. That's the Dow Jones Industrial Average. We could just as easily look at any foreign exchange pair and see how the volatility, really oscillates, really changes on a regular basis. But if we look back last year, last August in particular, I don't even have to look at the date. I know exactly where it is, judging from the Bollinger Bands. We're looking now, this is actually September 8th. The lower band, 10,300. The upper band, 10,479. Can you believe that? 179 point difference. If you compare that to the dates of May the 25th, we can even go a little bit further. 9,700, 9,800 basically, to the upper level, 11,497. So we went from a 400 point spread to a less than a 200 point spread. Now it's not necessarily the difference between the lower band and the upper bands, because we're not typically, when we're trading, we're not going to look at a daily chart, most of us, and say, yeah, I'm going to buy the Dow Jones Industrial Average when it hits the lower band. I'm going to sell short when it hits the upper band, and I'm not going to do anything in between. That would require us to have a tremendous amount of patience. That's not going to happen. We're day traders. We're short-term, swing-term traders. But it's important to note, you just look at what has happened lately. From the date of July 25th, the lower band was at, let's look at a foreign exchange pair actually, because that's even a little bit of a better example. Let me find something good here. What's a great example? The CAD yen. CAD yen, you look at the lower band, I'll go back to where I was. The lower band was at 81.25, 81.20 on June 27th, 82.90, 81.20, 82.90, 170 point difference, 170 pip difference. We go from 170 pip spread to 80.60 to 85, almost a 400 points difference. Now the important thing again is that most of us are probably not going to, just buying the lower band and selling the upper band. But notice what's more important is the increase or decrease in volatility. We had a very tight trading range, but when we broke out, we had 1, 2, 3, 4, 5 candlesticks in a row, 6 candlesticks in a row that were all green. More importantly, we went from a low of 81.30 to a high of 84.30 in a matter of 5 days. 5 days, 400 pips. If we had bought the CAD yen for whatever reason, let's say you forgot to take profits. You went on vacation and you forgot to put a limit order in. You come back from vacation and you see, hey, I just made 500 pips. It's a good vacation, right? Point being is that the market all of a sudden becomes very, very volatile. If we use, let's say, a day trading strategy where I'm going to buy a new high or I'm going to buy when the RSI does X, Y, and Z, whatever it may be, if I happen to guess right in buying the CAD yen for whatever reason, all of a sudden I start to really get rewarded. And all those program trading algorithms out there, they start to recognize the fact that the CAD yen's breaking out and they start to jump on board also. And this is when a lot of program trading systems also tend to do pretty well because they like trendy market conditions. So it's not necessarily, it doesn't matter so much where the position of the Bollinger Bands is, but is it increasing or decreasing? On the same note, the Bollinger Bands, if you look back in time, going back to April of this year, notice how the bands completely contracted from April, May down to June. That contraction makes trading very, very difficult because the last time I bought the CAD yen, I made 50 pips. This time I bought the CAD yen, I made 40 pips. And tomorrow when I buy the CAD yen, same strategy, I'll make 30 pips. All of a sudden the risk to reward starts to not so much be in our favor. August is an extreme example of that, the last couple weeks of August. Now specifically, what trading strategies can we use? Let's try to find a currency pair that's not really been moving right now. It might not be the easiest thing in the world. Things have been moving right now. Aussie dollar's been moving. Dollar CAD. Alright, it's been a little bit more quiet, but maybe the euro pound. And then we're going to talk about currency pair selection. This is a pretty good idea. This is pretty good. Okay, so we have the euro pound. Bollinger Bands. Are the Bollinger Bands wide apart or close together? They're close together. But more importantly, have they contracted? And the answer is yes. This is a daily chart. In fact, notice how much the Bollinger Bands have really contracted. All of a sudden, over the past couple of weeks, the story hasn't been so much about Greece. Stories then about the U.S. debt ceiling. Will Standard & Poor's downgrade the debt? All of a sudden, things in Europe seem to be a little bit more calm. The difference, the perception between the Eurozone and the UK, not that much of a big divergence. If I asked you, is there a big difference between the Eurozone and the UK 3 weeks ago, you would have said, yeah, sure, the UK is in this situation and Europe is in that situation. It's not the case right now. In terms of the market perception, the question is, are things similar or dissimilar to the US? Now, we have a triple bottom on the euro pound over here, and we see the Bollinger Bands have very much contracted. So the question is now, if we would have anticipated this to occur, that the euro and the pound would start to move together. And by the way, and please remind me if I forget, we want to talk about currency pair selection because that's very important. And we also want to talk about two things: currency pair selection and how news will affect this on a long and short-term basis. I'm going to get to that in just a second. But if we look at, let's say, a 1-hour chart on the euro pound, and we say to ourselves, well, maybe a 4-hour chart's a better example. It's not the cleanest example. I was hoping for something a little bit cleaner. Okay, well, we'll deal with it. If we say to ourselves, I expect the euro pound to be kind of range bound. In fact, let me go back to the daily chart. When did this range bound really start? Well, it's probably right over there, July 18th. All right, we'll go back to that. That's it. Okay. So I drew a vertical line July 18th. Now, if we anticipate these range-bound markets to persist, we can use something very simple like the Bollinger Bands. And in a range-bound market, very clearly, we do not expect the market to break out to new highs or to new lows. This applies on a long-term and short-term basis. Long-term, I don't expect the euro pound to break out, so I can use a long-term chart, like a 4-hour chart, and use a very simple, or even a daily chart, and use a simple buy low, sell high kind of approach. Now, the euro pound, it's not the best example because we can see there's still a little bit of a trend because the market did make new highs and new lows. But we would not have been terribly punished for buying near the bottom and selling near the top. Selling these highs, it would have been a little bit painful. Eventually, we would have obviously been right, and obviously taking profits in the center. Compare and contrast that to the strategy if we had decided to buy the lower band, Bollinger Band, just a couple weeks before, or a couple days before, the euro pound got crushed. Buying the euro pound at 89.60, it went down to 87.30, 200 points. That's a lot different than if we would have sold, let's say, at 88.18 and it went up to 88.70. See the difference? Before, when we tried to buy in the lower band, market went down 200 pips. Here, when we sold short the upper band, both would have been trades that would have been stopped out at, but the market only rallied another 70 pips. Now, on a short-term basis, that's what we would expect. I'm sorry, let me start back. Let me go back to the beginning. On a long-term basis, looking at the calendar, that's what we would expect to see. Bollinger Bands to contract, volatility to decrease, and the market not to break out. Buy low, sell high, take profits in the middle. You can use the Bollinger Bands or any other basic indicator, but the most important thing is to come into, I don't want to say come into the market with a predisposition. Let me refresh the charts here. I don't want to say that you should come into the market with a predisposition and say, okay, I'm going to expect this and nothing else. But judging the current conditions, taking into consideration everything else that's going on, what is most likely to occur? In the last couple weeks of August, when Congress is on vacation, we only have 5 big economic numbers for the entire month of August, only those GDP numbers, no central banks reporting, no corporate earnings. What's most likely? What's most probable? That the market's not going to move a lot. That's what I would expect to see. On a short-term basis, you can also expect the market to become very quiet outside of active market hours. So when you're going to trade this strategy, don't look for trades from 8 to 10 a.m. Eastern. when the U.S. market's very active. Even in August, the market can be kind of active. Look for these type of trades 11 a.m. Eastern, 12 around lunchtime. When all the traders go to lunch, that's when the market's least likely to break out. You know, the off hours. Also, the hours right before the release of a big piece of economic news. We have later on this week, we have European Central Bank meetings. Watch the European trading hours before those meetings. The markets tend to get very, very quiet before big economic data is released. Watch the markets at 7 o'clock in the morning this Friday, right before non-farm payrolls. And by the way, Canada's employment numbers released like an hour before the U.S., so be careful about that. But watch the market tends to get very, very quiet before the release of big economic data, in the absence of data, because all the traders, you know, what kind of trades are we going to place an hour before non-farm payrolls? Not me. I'm not touching the market. I'm going to wait for the numbers to be released. I don't want to get in front of the number and be wrong. So the market gets more and less active on a very predictable cyclical basis on a short and long-term basis. Long-term basis, August is quiet, July is active. September, medium, October, very volatile. July and October are two of the most interesting months of the year. But on a short-term basis, the markets are active during active trading sessions in the U.S. 8 to 10 a.m. Eastern, in Europe 3 to 5, in Japan 7 to 8. And they tend to get very quiet outside of the active sessions, and especially before the release of big pieces of news. Now, question is, do I expect more volatility in the U.S.? That's a great question. Let's see. The U.S. dollar has been very directional to the downside. Expect more volatility? I would expect things to slow down in August. I expect everything to slow down in August. As far as the dollar is concerned, I mean, it's really, I think, you know, my answers I really don't know, because I'm not exactly sure how the market is going to perceive all this. My best guess, I mean, in terms of will S&P downgrade the credit rating? Well, we don't even know if the Senate will pass this bill. Probably they will. I mean, that's what everybody guesses. But based on this move alone, and based on the counter move in gold to the upside, because as the dollar has gone down almost every single day, gold has gone up almost every single day. Gold hitting new historic highs in lockstep with the dollar hitting new historic lows. If you look at a chart, I would tell you it really kind of feels that we're reaching, at least on a short-term basis, I don't know what the term is, I guess you call it like a blow-off period, where, you know, the market goes up and up and up, and all of a sudden it really starts to accelerate at the end. The last part of a move in a trend is usually the fastest part of the trend. A stock will go from 10 to 20, back to 15, and then from 15 to 25, and then back to 20, and then all of a sudden, news is released, and the stock is 30, 40, 50. It seems to just accelerate as all the buyers get on one side and all the sellers just run away until we reach that critical, you know, inflection point where we hit that all-time high, and every single person out there who wanted to buy already did buy, and every single person who wanted to sell short has basically run away. And then what do you have left? A room full of buyers. It feels like the dollar has accelerated recently. And it makes sense that it coincides with, first of all, the big economic and political, you know, picture that we're looking at in the U.S., but also in terms of corporate earnings. And it makes sense that after this issue has passed, and after corporate earnings have passed, and we've entered that very quiet trading month of August, the U.S. dollar needs a vacation, so to speak. That there's no more reason for it to move. At least it doesn't have as much of a reason to sustain the current trend. I would expect things to slow down, and maybe even some sort of, I don't know, maybe a technical bounce. Our former support could become new resistance at 7,900 in dollar Swissy. Long-term resistance near 8,300. And you'll notice, by the way, take a look at the following chart. No, I know there's a lot of lines here, but if you take a look at the chart, the dollar Swissy, the trend is to the downside. When we're trading in the same direction as the trend, the market tends to move very fast. When it retraces, that's when the market tends to slow down as well. Notice the general length of the candlesticks. When the market's going down, we can spot these very, very big candlesticks. Now, of course, there's small candlesticks, big candlesticks all over the chart, but generally speaking, I think you'll agree that the biggest candlesticks are moving in the same direction as a long-term trend. Every big move is to the downside. Every big candlestick, more or less, is to the downside. There's a couple of big ones going up. But generally speaking, when the market goes up, that's when you start to see the little candlesticks. And it's a principle that really I've sort of adopted from the Elliott wave principle. For those of you that are not familiar, the Elliott wave principle is basically a cycle theory where the market will move in a regular, predictable cycle. And when it moves in the same direction as its long-term trend, the moves are called impulse moves. And those are motive moves. And those moves tend to be very, very fast and very, very big. And then after that, you have your retracement moves, or the retracement, or there's other words for it. And that's when the market tends to get choppy. And that's when you tend to see the triangle consolidation patterns. I mean, if we were to look for triangle consolidation patterns on the dollar Swissy, we would look for these retracements. And these retracements that move against the long-term trend, which is to the downside. Rarely do we see a triangle that moves in the same direction as the long-term trend. Triangles don't really go down. They go up in a long-term trend to the downside. And we rarely see the market really break out to the upside. We see big candlesticks. But generally speaking, maybe I could draw another line here. There we go. Generally speaking, when the market pulls back against a long-term trend, then it tends to get slow. So to answer your question, yeah, I see volatility slow down. I would expect volatility to slow down in the dollar Swissy and the other dollar crosses in the month of August, number one, because we have less news. Number two, hopefully we're going to get through this entire debt ceiling issue. And number three, I expect a retracement. And just for the simple fact that I expect a retracement, I expect the candlesticks to get smaller. It's really kind of fun and fascinating how we can blend in. You can look at the market from the point of view of technical analysis. The trend is your friend. Are we moving in the same or opposite direction as the trend? Number two, take a look at the calendar. See what time of the year are we, meaning is this considered an active month or an inactive month? And we can also look at the news events, the big pieces of news, which takes me to my next point, which is, I think, the fourth different way you could look at the market, specifically the foreign exchange market, which is currency pair selection. Now, when we trade stocks, we buy Google if we think Google is going to go up. We short Apple if we think Apple is going to go down. With the foreign exchange market, I actually recently put together an article that compares the foreign exchange market to, basically says that the foreign exchange market is the greatest arbitrage market in the world. Arbitrage trading is when, and it's really a fascinating side of financial trading, of speculating in the financial markets. If I were to ask any one of you, which stock do you wish you would have bought 5 years ago? Apple or RIM? RIM makes BlackBerry. Everybody would say Apple. Which stock do you wish you would have bought? Blockbuster, which just went out of business, or Netflix, which is not going out of business. Which stock would you have wished you would have bought, a couple of years ago? Baidu. Barnes and Nobles, or or Amazon.com. Barnes and Noble sells books in the store. I know they have a website also, but basically people think of them as a store-driven, location-driven type of business. Amazon.com sells everything online to everyone. Apple, I heard a statistic on a Bloomberg article, was it last week or a couple of weeks ago? A couple of years ago, the statistic was for every one person that owned a BlackBerry, 4 people owned an iPhone. Now that ratio has gone from 4 to 1 to 20 to 1. For every one BlackBerry user, there's 20 iPhone users. Think of your closest friends and family. How many of them own a BlackBerry? How many of them own an iPhone? It's gone from like 4 to 1 to 20 to 1. I don't have to tell you how well Apple has done. I think RIM just announced a layoff of like 2,000 employees a couple of weeks ago. There's a very, very big divergence. Blockbuster, which is a business based on the premise we have to get in our car and drive to rent a DVD, versus Netflix, which is a business in the old days, they would mail you the DVD, but now you can just access it online in about half of 1 millisecond. Blockbuster's going out of business, or has gone out of business. Netflix, well, if you haven't seen the stock, take a look. It's doing well, needless to say. That is arbitrage trading. Buying one financial instrument that you think is going to do well, and shorting another instrument that you think is not going to do well. That's trading the foreign exchange market. Selling the dollar, buying the Swissy, based on the premise that you think that the fundamentals in Switzerland, because the price of gold is higher, are going to be better than the dollar. That's FX trading. That's the forex market. It's the greatest, most beautiful example of trading in the foreign exchange market. In terms of range-bound trading, I don't want to compare Apple to BlackBerry or Blockbuster to Netflix. What are two very likely examples? I want to compare Lennar to Hovnanian. They're both home builder stocks. Neither one is doing well. Neither one will probably do well in the future. But they're both not doing well together. If I were to, short Hovnanian and go long Lennar, I'm probably not going to make or lose a lot of money anytime soon. What are two other examples? What's the sector that's been doing well right now? The manufacturing sector. So you could say manufacturing. You could say, so here's another example. You could say, I'm manufacturing. What's a stock like ITW? I haven't looked at the stock in a while. ITW, Illinois Tool Works. They make these tools that the manufacturing industry really depends on. They've been doing really, really well. Compare that to another manufacturing stock, Caterpillar, John Deere. Those have been doing well. But those stocks probably haven't diverged from each other too much. In terms of the foreign exchange market, what theme do we expect to persist in August? Remember, everybody is worried right now about the U.S., but maybe they're ignoring Europe. Maybe the euro against the pound. Now, the euro against the Swissy is a different story, because the Swissy's been moving with gold, and gold has been making new all-time highs. So the euro Swissy has been making very, very big lows. So if I'm going to trade range-bound, buy low, sell high, I'm not touching the euro Swissy. I want to touch two currencies, put two currencies together. I think they're going to move kind of close to each other. The euro and the pound. Or maybe possibly the Aussie Kiwi. Because at the beginning of this conversation, last week we said the Reserve Bank of New Zealand met and they said, inflation is starting to pick up, things are looking good, but we're waiting for this global uncertainty to pass. The Reserve Bank of Australia met earlier today and they said, inflation's picking up, things look good, but we're waiting for this global uncertainty to pass. There is a trend though. The Kiwi is significantly stronger than the Aussie. This is the Aus Kiwi chart, by the way. That's why there's the trends moving to the downside. Generally speaking, if we're looking for a range-bound currency pair, you want to look for a currency pair where the two currencies within a pair tend to react in a similar fashion under the same sort of climate. Normally, I would expect the Aussie Kiwi to be that currency pair, and it is. But sometimes it gets trendy. It's a little bit difficult. We could say maybe the Aussie CAD, because they're both commodity-based currencies. I know the Aussie has much higher interest rates than the Canadian dollar, but they're both commodity-based currencies. But unfortunately, the CAD's been a lot weaker. Things have been very, very trendy. But I promise the solution will really reveal itself. Maybe the dollar CAD. Because the dollar's been very weak. The CAD's been moderately weak. But if we're expecting the dollar to sort of rebound a little bit in the middle couple weeks of August, we might expect the dollar CAD to sort of flatten out. Also, the Canadian economy, it watches the U.S. economy pretty closely. So if things start to, go down in the U.S., they're going to go down in Canada and vice versa. The answer right now is not 100% clear because we're still in the midst of this, this situation this really, really big volatile situation right now. But as we get closer to the month of August, or we're in the month of August, as we get closer to those really quiet 2 or 3 weeks, then we would expect things to slow down. When would we expect things to pick up? Well, we have retail sales we have to watch out for in September because it's back to school. My prediction is Apple's probably going to sell a lot of iPads. And we have, of course, October earnings season, which is certainly a very volatile month. But getting back to the topic of the day, in terms of trading the last couple weeks of August, we want to, number one, try to find a currency pair that we have has a good chance of not moving. Put two currencies that are going to react in similar fashion. I wouldn't put the dollar against the Swissy or the euro against the Swissy, but rather the dollar and the CAD, or the euro and the pound. Maybe the Aussie and the Kiwi, or the Aussie CAD. Number two, find that period of time on a long-term basis, on the calendar basis, when we think the market is least likely to move. That's after this week, and after the Federal Reserve meeting next week. After the Fed meeting next week, remember, we only have GDP numbers for the entire month of August, aside from little numbers. Those are the only big numbers. We have no corporate earnings, no more central bank meetings. Very, very quiet. Specifically, look for those periods of time when the market's not active, when news is not going to be released. And look for that period of time when the market is waiting for a big piece of news. 7 a.m. Eastern, before non-farm payrolls, the market does not have a lot of reason to move, and most people are sitting on the sidelines. Currency pair selection, time of the year, time of the day, all these things, we put them together. The whole purpose, the whole goal is to give us the best chance of finding that really quiet period of time when the market's least likely to break out, so we can very simply throw our Bollinger Bands on a chart and say, okay, I'm going to use a buy low, sell high approach, buy near the lower band, sell near the upper band, take profits in the middle when the market's least likely to break out. When is Trichet stepping down? Who will replace him? I don't know. Is that news out? I have not heard a single thing about that. It's going to be a pretty big event. I'm not sure. I'm embarrassed to say I don't know. It's going to be a pretty big event, and I know I'm running out of time here. I like Trichet. I like Trichet because he's very consistent, and his message is always very clear, and he likes raising interest rates. He says, we're going to raise interest rates. I know that Greece is in trouble. I know that Spain and Ireland and Portugal are in trouble, but there are inflationary pressures, and my responsibility is not to manage the debt-to-GDP ratio in Greece or the unemployment rate in Spain, but rather the central bank's job is to raise and lower interest rates based on inflationary pressures. That's if you look at it in a dictionary, I don't know, I'm guessing, but I'm guessing that if you look in the dictionary, that's the definition of a central bank. To raise or lower interest rates based on inflationary pressures. Ben Bernanke, he tends to be a little bit more reactionary towards, I think, political pressure. He said a couple weeks ago, he says, we leave the door open for QE3. And then the next day, the stock market goes up 100 points and the dollar goes down 200 pips. And then the next day he comes out and says, you know what, I'm not going to initiate QE3. Trichet, yesterday he said, I'm going to raise interest rates if inflation continues. Today he's going to say the same thing, and tomorrow he's probably going to say the same thing. And it's a lot easier as a trader because I know if inflationary numbers increase in Europe, I know what Trichet is thinking. I know what he's probably going to do. I like that. He's gutsy. I agree. If his replacement is maybe not so gutsy, I don't know. What is that going to do for the euro? It's going to make it maybe a little bit more difficult to trade. Unfortunately, we're not going to find out during this trading session because I'm out of time. If you have any questions, you can always contact me directly, www.forex.com. I want to thank you all very much for joining us. Thank you, Harley. Thank you, FX Street. Please see the calendar. We have a great schedule for this month. We have a lot more going on. Again, I want to thank you all very much for joining us. Wish you a great day, all profitable trades, and we look forward to seeing you back soon.